Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Luis, and I'm excited to share today's stories with you. We're starting off with a couple of interesting developments in the Indian stock market. First up, Gensol engineering shares have hit the 5% upper circuit for the third consecutive day, despite some serious concerns around corporate governance and financial misconduct. The company's managing director, Anmol Singh Jaggi, and whole-time director, Puneet Singh Jaggi, resigned earlier this week following allegations of fund diversion and loan defaults. The Indian Renewable Energy Development Agency, or AIDA, has filed an insolvency petition against Gensol Engineering over a loan default of Rs 510 crore. This comes after SEBI barred the Jaggi brothers from accessing the securities market, alleging that they siphoned off loan funds for personal use. The Enforcement Directorate has also raided the company's premises, seizing documents and electronic devices. It's worth noting that Gensol's stock has plunged over 93% in the past year and 55% in the last month alone. This is a significant drop, and investors are likely to be concerned about the company's future prospects. In other news, Raymond Group's demerger plan has been put on hold due to regulatory issues. The company had announced plans to demerge its FMCG business into a separate entity, but it seems that the process has hit a roadblock. We're also keeping an eye on the story of Gensol Engineering's co-founder, Anmol Singh Jaggi, who is also the founder of Bluesmart Mobility, an electric vehicle ride-hailing platform. There are allegations that funds were diverted from Gensol to finance Bluesmart's operations, which has raised questions about corporate governance and financial management. It's a complex story, and we'll be keeping a close eye on developments as they unfold. As always, we'll provide you with balanced and unbiased analysis, helping you to make sense of the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and investments, where the stakes are high and the rewards can be significant. Today, we're taking a closer look at the Indian steel industry, as well as the paint segment, particularly Asian paints. Our story begins with Tata Steel, which has been making headlines recently due to its impressive numbers. With the price of steel at a 4-year low, imports at a 10-year high, and a 12% safeguard duty in place, the company is poised for growth. In fact, Tata Steel's EBITDA in the domestic market was around Rs 12,000 per ton, with the company guiding for overall price appreciation of Rs 3,000. This is certainly good news for investors, and it's no wonder that many are taking notice. But what about the rest of the steel industry? Hindalco, for example, has also reported strong numbers, particularly in its Novelis segment, where EBITDA per ton was better than expected. And then there's JSW Steel and Jindal Steel and Power, both of which are expected to do well in the coming quarters. Now let's shift our focus to the paint segment, where Asian Paints has been facing some challenges. The company's volume growth has been sluggish, at around 2-3% over the last 2 quarters, which is significantly lower than its long-term growth rate of low double digits. And with Birla Opus offering lower prices, there's pressure on margins as well. So, what does this mean for investors? Well, it's clear that the steel industry is looking up, with companies like Tata Steel and Hindalco leading the charge. But when it comes to Asian Paints, the picture is a bit more mixed. While valuations may be attractive, with the stock trading at around 44 times forward earnings, volume growth needs to pick up before investors can get really excited. As always, we want to remind our listeners to do their own research and consider multiple perspectives before making any investment decisions. The world of finance is complex and ever-changing, and it's essential to stay informed and adapt to new developments. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we wrap up today's show, Let's take a look at some of the latest news and developments from around the world that could impact your investments. We've seen a flurry of activity in the banking sector, with several major Japanese banks releasing their earnings forecasts for fiscal 2025. Mizuho Financial Group is expecting record earnings despite a potential dent from U.S. tariffs, with net income projected to climb 6.1% to $40 billion. Meanwhile, MUFG is anticipating a record profit and plans to buy back up to $250 billion of its own shares. Sumitomo Mitsui Financial Group is also expecting a strong year, with net income projected to rise about 10% to $8.3 trillion. These forecasts come as the banking sector continues to navigate the challenges posed by global trade tensions and rising interest rates. The Bank of Japan's decision to raise rates for the first time in 17 years has boosted profits across the industry, but uncertainty around U.S. tariffs is making business planning more unpredictable. In other news, Trump's tariffs have spared the Europe-dominated hearing aid industry, at least for now. However, his threats against Greenland have sparked jitters in Iceland, and the debate over who should pay for Mount Fuji rescues continues to simmer. As we consider these developments, it's essential to remember that investing always involves risk. It's crucial to stay informed, diversify your portfolio, and be prepared for unexpected twists and turns. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.